Welcome to a brand new explainer right here on the Gap Advisors IndAS Clinic YouTube channel. Today, we're going to demystify the absolutely fascinating, and let's be honest, sometimes pretty complex world of hedge accounting. We're going to be breaking down a very specific foreign trade payable case study together. Now, just a quick heads up before we really get into the weeds, the views expressed here are the personal views of the author and are not binding on the audience. We always request that you seek the help of an expert before taking or refraining from any action based on what we discussed today. Also, I should mention that the specific issue we're tackling is pulled straight from the incredible issue repository over on gapadvisors.com. It's an amazing resource that hosts over 4,500 issues and responses on Indian accounting standards and Indian GAAP. Anyone can register for free and submit issues to get a detailed response delivered right to their inbox. It's honestly incredibly useful, especially for auditors who need to document exactly how they addressed any issue relating to the application of IndAS. And to give you a little more background, this explainer actually discusses an issue featured in the 226th edition of the Gap Advisors Task Weekly newsletter that's authored by CA Manish C. Iyer, Director of Gap Advisors, and published on LinkedIn. With 232 editions published to date, I highly recommend you go and subscribe to that for free. All right, let's quickly look at our agenda for today. We've got 1. The foreign currency setup. 2. The dilemma. 3. Choosing the right hedge. 4. Measuring effectiveness. 5. The accounting cycle. And 6. Our journal entries masterclass. Section 1. The foreign currency setup. The $1,000 challenge. Okay, so let's set the stage. Picture this. Your company has a foreign trade payable of exactly $1,000. At the current exchange rate, that is equivalent to exactly 60,000 Indian rupees. Now, keeping in mind that our standard Indian financial reporting period runs from April 1st to March 31st, this payable is due in exactly 3 months, meaning this 3-month clock is actually going to cross right over our year end. This is a classic scenario that I know a lot of finance teams know all too well. So what do? Well, to smartly hedge this foreign currency exposure and protect the company from some wild exchange rate volatility, the company decides to take action. They enter into a 3-month forward contract to buy that exact amount of $1,000. This brilliantly locks in their rate and gives them complete predictability.
Moving on to Section 2, the dilemma. 3 key accounting queries.
Now, setting up the contract with the bank, that's the easy part, right? The real dilemma is how we account for it. This brings us to 3 critical questions we really need to solve today. First, are we going to designate this forward contract as a fair value hedge or a cash flow hedge? Second, how on earth do we calculate the effectiveness and ineffectiveness of this hedge when there won't be any change in the fair value of the hedged item itself, just the movement in those foreign currency rates? And third, what do the specific journal entries look like at initial recognition, at our reporting date, and finally, upon settlement? Which takes us to Section 3, choosing the right hedge. Fair value versus cash flow. So let's tackle that first hurdle. While the rules technically say the forward contract can be designated as a hedging instrument in either a cash flow hedge relationship or a fair value hedge relationship, a cash flow hedge is simply not recommended when you're dealing with a recognized asset or liability that is a monetary item for foreign currency risk. Because our trade payable is already a recognized monetary liability sitting there on our books, the fair value hedge is the clear recommended winner here. Section 4. Measuring effectiveness, governing the rules. With our fair value designation locked in, how do we measure if it's actually working? The underlying logic here is beautifully simple, honestly. The effectiveness of the hedge is calculated simply by comparing the changes in the fair value of your hedging instrument, which is our forward contract, directly against the changes in the fair value of your hedged item, which is that $1,000 trade payable. But wait, how exactly do we find that fair value change for the payable? To do that, we rely strictly on IndAS 21, the effects of changes in foreign exchange rates. This specific standard dictates that changes in the fair value of a trade payable relating to currency risk must be recognized as an exchange gain or loss by translating the payable at the closing rate. That closing rate translation, that becomes your absolute benchmark for the hedged item's fair value change.
All right, Section 5, the accounting cycle. Initial, reporting, settlement.
We've laid all the theoretical groundwork, so let's look at the timeline mapping out exactly when our finance team needs to act. We have day 1, which is our initial recognition. Then, right in the middle of our 3-month contract, we inevitably hit our standard year-end reporting date of March 31st. And finally, we conclude at the 3-month mark with settlement. Let's dive into the actual ledgers for each of these 3 stops, assuming the settlement of both the trade payable and the forward contract will be done on a gross basis.
Here we go, Section 6, Journal Entries Masterclass, Step-by-Step Ledgers.
Let's start right at the beginning. Surprisingly enough, at initial recognition on day 1, there is absolutely no journal entry passed. No way, right? But it's true. Why? Because at the exact moment you sign it, the fair value of the forward contract is exactly 0. There's nothing to record yet.
Now, fast forward to our year-end reporting date on March 31st. We have to revalue our positions. First up, we look at our hedged item. Let's say the currency moved against us. Our first entry adjusts the liability by debiting the foreign exchange gain or loss on trade payable account and crediting the trade payable account itself to increase that liability to the new closing rate.
But here is exactly where the hedge does its job. On that exact same March 31st reporting date, we mirror this action for our hedging instrument. Because the payable went up, the forward contract is gaining value. So we debit the forward contract asset account and we credit the foreign exchange gain or loss on forward account. Notice how these two entries effectively offset the risk in our P&L? It perfectly neutralizes the threat. It's pretty satisfying when it works out like that.
Okay, settlement day finally arrives at the end of month 3. Our first step, before any cash actually changes hands, is to book the final fair value adjustments to true up our balances for today. We debit the trade payable and debit the forwards exchange gain or loss account. Then, to balance this whole thing out, we credit the payables gain or loss account and we credit the forward contract itself.
Finally, to close out the cycle completely on a gross basis, we settle the actual cash. We debit the trade payable to clear the liability and credit the bank for the cash outflow to our supplier. Simultaneously, we debit the bank for the cash inflow from fulfilling our forward contract, and we credit the forward contract to clear that asset right off our books. Everything is perfectly balanced.
It's a truly fascinating process that keeps our ledgers perfectly balanced and completely compliant with IND AS. But, it leaves us with a vital question to ponder regarding your own company's risk management strategies. Think about it. If a routine $1,000 payable requires this much precision, what hidden currency risks are quietly impacting your unhedged bottom line right now? Listen, I want to thank you so much for your time today. If you found this structured explainer helpful, please do us a huge favor. Like this explainer, add your comments down below, and make sure you subscribe to the Gap Advisors IND AS Clinic channel if you haven't already. We would also highly request that you share this explainer among your contacts, your colleagues, and especially your audit and finance teams to help spread this really vital knowledge of Indian accounting standards. And finally, if you want a true deep dive into the issue we dealt with today, please connect to the Gap Advisors IND AS Clinic podcast, available right now on Spotify, Amazon, or YouTube. Keep learning, keep structuring your knowledge, and we will catch you in the next one.